Good morning. Welcome to another episode of the Mstardom Finance Weekly Review of the U.S. economy. The economy has been doing some amazing things, or going through some amazing phases, and I've been taking note. And again, my name is Glenford Robinson, and I'm going to be talking about the U.S. economy, the status of the U.S. economy, and this is my opinion. All right. Again, I'm not a licensed investment advisor as yet, but I'm studying. And everything that I talk about here, it's on my it's in my article. It's my article that I'm talking about. My weekly article that I write and I post on. I publish on Mstardom.com. That's Mstardom.com. All right, so what am I going to be talking about today? All right, the title of the article is U.S. economy experiencing slow growth confirmed by non-farm payroll, manufacturing, and retail sales data. And again, my name is Glenford Robinson. All right, so the first thing that we'll go over is the non-farm payroll. The non-farm payroll was released October 4th, 2019 at 8:30 a.m. The non-farm payroll numbers came in. They weren't very good. So let's see what happened. Let's see what I wrote about. All right. The article goes as follows. Non-farm payroll in the U.S. increased by 136,000 in September 2019, missing expectations of 140,000, coming well below the previous mark of 168,000 set in August. The non-farm payroll report measures changes in the number of people employed during the previous month, excluding those who work in the farming industry, in unincorporated self-employment, in private household, at nonprofit organizations, those who work in the military, at intelligence agencies, and those who are proprietors. The creation of jobs increases consumer spending. The more people with jobs increase, the more money will be present in the economy, thereby increasing personal income rates and overall economic activity. The Bureau of Labor Statistics releases the non-farm payroll report at 8:30 a.m. on the first Friday of every month for the previous month. The non-farm payroll report falls into the category of a coincident economic indicator because the report tells us what took place economically in the recent past of a month ago. So the report gives us a synopsis of the current health or state of the economy in regards to cash flow flowing from the pockets of employed consumers into the economy. In regards to the U.S. economy, the non-farm payroll number came in 4,000 payroll below the consensus estimate of 140,000 and well below the previous mark of 168,000 payrolls. So what are these numbers telling us? These numbers tell us that the current report barely missed the projected mark. So the fact that the close miss was to the downside, caution should be exercised when embarking on any investments. Time horizon should therefore be taken into account. Are you planning on retiring in 6 months to a year, 2 years time, or are you planning on retiring 10 years from now? If you're planning on retiring 6 months from now, then you should get on the phone with your professional investment advisor and make sure that your retirement portfolio is safely allocated in order to withstand any short-term economic downturn, which will subsequently cause equity markets to slow down. A longer time horizon retirement portfolio will be less susceptible to short-term economic slowdowns, because a longer time horizon retirement portfolio will be able to ride out a short-term market downturn without long-lasting negative effects. A higher than expected non-farm payroll report reading should be perceived as a positive for the United States economy and bullish for the US dollar, while a lower than expected reading should be taken as a negative for the US economy and bearish for the US dollar. Alright, that still continued. Foreign currency traders and equities traders look to the non-farm payroll report as a market movement catalyst, because on the date and time of the non-farm payroll report release, the forex market increases in volatility. The largest market movement occurs when the current reading misses forecast by a large margin, while the smallest or least amount of market volatility occurs when the current reading comes in at the forecasted reading value, otherwise known as priced in. A close margin between the forecasted 140,000 payrolls and the actual reading of 136,000 payroll is not very large. Therefore, we should have expected that the forex and equities market would have reacted accordingly by not exhibiting too much volatility. And for the most part, that was what happened, especially in the forex market, on the date and time of the non-farm payroll report release. In addition, statistics data from the non-farm payroll shows sectors that have generated the most employment additions. In regards to large gains and losses, the report lists sectors such as professional and business services, healthcare, financial activities, mining, construction, manufacturing, wholesale trade, retail trade, transportation, warehousing, information, government, leisure, and hospitality. Financial analysts following the stock market use this breakdown to predict which stock and sectors will have the strongest earnings report. According to our current September non-farm payroll report, the professional and business services sector, mainly transportation as well as the healthcare sector, added more jobs. Employment in professional and business services continued to rise in September, thereby adding 34,000 jobs. And the industry added an average of 35,000 jobs per month thus far in 2009, compared with 47,000 jobs per month in 2018. While healthcare added 39,000 jobs, in line with its average monthly gain over the last 12 months. Ambulatory healthcare services added 29,000 jobs, and hospitals added 8,000 jobs over the past months. Okay, now let's go into the October unemployment report, the unemployment rate for September. Okay, let's see how that did. We just went over the non-farm payroll, and that didn't do all that great. So let's see how the unemployment rate fared. Okay, based on the article I wrote, goes as follows. The economy is still trading water, has depicted in the employment situation summary from the U.S. Department of Labor statistics. The unemployment rate declined only by 0.2%. From 3.7% to 3.5% in September. This kind of weak improved change should not be looked at as too promising, and should therefore be treated as cautiously as possible, because things could easily slip the other way. Have you ever heard the saying, too close for comfort? Well, this is just too close. A 0.2% improvement over a very low ball forecast of 3.7% coupled with a previous reading of 3.7% is an abomination. So, if the forecast was also 3.7%, that tells us that the forecasters did not expect much of an improvement from the previous month. It is just like knowing that an entity doesn't have much to offer, so no one expects too much from it. It is like having a large black cloud hanging overhead with the chance of a tropical storm. But the storm has not materialized as yet. But it could materialize and burst through the clouds at any moment. This is where we are with the unemployment report as well as the non-farm payroll report that underperformed its forecast. So, what is the unemployment rate report? The unemployment rate report measures and displays a percent of the total workforce that is unemployed and actively seeking employment during the previous month. A higher than expected reading should be taken as negative for the U.S. economy or bearish for the U.S. dollar, while a lower than expected reading should be perceived as positive for the U.S. economy or bullish for the U.S. dollar. This is a moot point because the slight volatility of the currency market did not react forcefully in a way that would support this assumption, and we know why. Even though the unemployment rate reading came in below forecast, which could be looked at arbitrarily in a positive light, it really didn't impress. In fact, the last time the rate was this low was in December of 1969. That's the year I was born, when it also was 3.5%. In the past month, the number of unemployment persons decreased by 275,000 to 5.8 million, according to the Employment Situation Summary. All right? So now, we went over non-farm payroll and on the unemployment rate. Let's see if the ISM non-manufacturing PMI fared any better. What do you think? All right. For this report, this is called the ISM non-manufacturing PMI for September, and it was released on October 3rd, 2019 at 10 a.m. All right, so this is what I said in the article. A very good predictor of GDP growth and subsequent economic growth happens to be the ISM non-manufacturing PMI. The Institution of Supply Management, ISM, Non-Manufacturing Purchasing Managers Index, PMI, also known as the ISM Services PMI, provides in-depth reporting on business. The Non-Manufacturing Index, NMI, function as a composite index based on the diffusion indexes for 4 of the indicators with equal weights. The 4 indicators happen to be seasonally adjusted, and they are business activity, new orders, employment, and supply deliveries. An ISM non-manufacturing purchasing managers PMI reading above 50 indicates expansion in the sector. What do you think? You think our economy is expanding? Okay, let's continue. While a reading below 50 indicates contraction in the sector. In our current ISM non-manufacturing PMI report, we see that the actual reading of 52.6 missed forecast of 55.0 and came in well below a previous reading of 56.4. So, that is telling us that even though the actual result missed forecast by 2.4 points, a reading of 52.6 comes in above the target of 50, which could be interpreted as some degree of growth or expansion in the non-manufacturing PMI sector, and thus in the U.S. economy. However, this degree of growth is very, very slow or small, to say the least. Not large enough to show any significant improvements in the last few GDP numbers. And if you had gone over my last week's video, I went over how the GDP has been doing. And the past GDP has been 2.0, and the forecast was 2.0, and the actual was 2.0. What's that telling you? No improvement at all. Flatlining. All right? All right. So, the improvement of the ISM non-manufacturing PMI, non-manufacturing PMI, could be perceived as some levels of improvement, but to what degree? Not a very large degree, because a reading of 52.6 is not all that great, because the benchmark is 50, and you don't only get 52.6. Come on, that's not all that great, man. We want to be doing much better than that. Much better than that. So now we will talk about the ISM Manufacturing Purchasing Managers Index, PMI, report on business. Let's see how that did. The ISM non-manufacturing PMI didn't do all that great, so let's see. Maybe the manufacturing PMI may, do something better. Well, let's see. The ISM Manufacturing PMI for September was released on Tuesday, October 1st, 2019 at 10 a.m. Okie doke. So let's see what I said in the article. You think it did better? Do you think the ISM Manufacturing PMI for September did better than the non-manufacturing PMI? All right, let's see. Drum roll. Let's see if you're correct. The Institution of Supply Management, ISM, Manufacturing Purchasing Managers Index, PMI report on business reflects compiled data derived from monthly replies to questions asked of purchasing and supply executives in over 400 industrial companies. The indicators measured includes new orders, backlog of orders, new export orders, imports, production, supplier deliveries, inventories, customers, inventories, employment, and prices. The report depicts the percentage of respondents, the net difference between the number of positive responses and negative responses in regards to the direction of the economy, and the diffusion index. The collected responses are compiled raw data that will never be changed. The diffusion index includes the percent of positive responses plus 1/2 of those responding the same, which is considered positive. The single index number that results is then seasonally adjusted to allow the effects of repetitive intra-year variations, resulting primarily from normal differences in weather conditions, various institutional arrangements, and differences attributable to non-movable holidays. The U.S. Department of Commerce supplies all seasonal adjustment factors, which are subjected annually to relatively minor changes when conditions warrant them. The PMI functions as a composite index based on the seasonally adjusted diffusion indices for 5 of the indicators with varying weights. The indicators are new orders, 30%, production, 25%, employment, 20%, supplier deliveries, 15%, and inventories, 10%. A higher than expected reading should be perceived as positive for the U.S. economy or bullish for the U.S. dollar, while a lower than expected reading should be perceived as negative for the US economy or bearish for the US dollar. In regards to the forex market, when the US dollar assumes a bullish trend or an upward direction, other currencies assume a bearish or downward direction. This is because the US economy happens to be the strongest economy in the world. A good example would be the Euro-USD currency pair. In this pair, where the US dollar exhibits a bullish trend, the Euro, on the other hand, will assume a bearish trend. Based on the October 1st ISM manufacturing report, the actual reading of 47.8 came in well below forecast of 50.4 and also below the previous reading of 49.1. There we go again. Yet another economic indicator showing negative or slow economic growth. We can look at these negative numbers as the normal ebb and flow of the US economy, but that wouldn't be totally correct, because in an ebb and flow situation, we would normally see an up and down progression and regression of growth in the economy. But what we're seeing is a constant ebbing or slowing of growth in the economy. The next economic indicator we will look at is retail sales. Let's see how retail sales did. What do you think it did? How well do you think retail sales did? Put your comment below if you were able to predict what's coming next and what has been coming next. All right. Okay, the next economic indicator we will look at is retail sales. Retail sales go hand in hand with the manufacturing activities and inventory levels. Strong retail sales directly increase GDP and economic growth, which also strengthens the home currency. Companies can hire more employees when sales improve, thereby putting more money in consumers' pockets. The hiring of more employees gives companies the ability to produce more products, thus increasing the level of manufacturing activities in the economy. The telltale sign of a growing economy. So do you think our economy is growing? Let's see what happens. So let's see how well the most recent U.S. retail sales report did. In fact, before going any further, we can predict with a certain degree of accuracy based on what we saw in the ISM non-manufacturing PMI and the ISM manufacturing PMI that the retail sales report will come up short and not meet expectations. Okay, now, drum roll, commercial break. Take a break, less than a minute. Take a sip of coffee, sip of water. All right, make money trading Forex market. If you would like to learn how to trade the foreign currency market, otherwise known as the Forex market, using both fundamental analysis and technical analysis approaches, please call 631-747-7237. It is preferable to send a text message stating that you are interested in learning how to trade the Forex market, utilizing fundamental and technical analysis principles. Investment banks and other institutional traders use fundamental analysis and some degree of technical analysis to trade the Forex market. I will show you how to use descriptive statistical and retail sentiment approaches to trade the Forex market. I will also show you how to determine which direction the Forex market is heading in at a given point in time, and how to recognize when a directional change or a reversal is about to occur or is occurring. And I will help you develop your own Forex trading strategy. We recently built a Forex trading algorithm which is currently being tested. In fact, it is already providing our traders with accurate directional signals and buying and selling levels. It is not currently for sale. However, if your organization is an investment bank, hedge fund, or similar investment organization and wishes to spend between $40 and $50 million, then please contact us. And the number again is 631-747-7237. Thank you. Now back to the discussion of the article that I wrote, and I'm going to be publishing it. So you have to, if you want to see what I'm looking at to do this particular broadcast, you'll just go to mstardom.com and you'll see the article yourself. All right, now we're going to go over retail sales, but the first aspect of retail sales that we're going to go over is the core retail sales. The core retail sales and the retail sales is a little different, and I'm going to point out the differences. All right. Okay. For the core retail sales for August was released September 13, 2019. And what do you think? How do you think it did? Huh? Let's find out. The core retail sales report measures changes in the total value of sales at the retail level in the U.S., excluding automobiles. The report shows the rate of consumer spending. It functions as a pace indicator for the U.S. economy, how fast or how slow the growth of the economy is currently progressing. As we can see in the report, the previous reading was 1.0%, the forecasted reading 0.1%, and the actual reading came in at 0.0%, a whopping 0.0%. So, this is confirming that U.S. economic growth has slowed down dramatically, or is slowly growing. However you want to look at it, things are slow, or not growing at all. Flatlining. That's like what the GDP is telling me. Flatlining. Not very good. A higher than expected reading should be perceived as a positive for the U.S. economy and bullish for the U.S. dollar, while a lower than expected reading should be perceived as a negative for the economy and bearish for the U.S. dollar. So there you have it. The core retail sales didn't do all that well. It showed us that the economy is slowing down or stopping. However you want to look at it. Now, let's go over the retail sale. We just went over the core retail sales. Now we're going to go over the retail sales. Retail sales, month over month for August was released on September 13, 2019 at 8:30 a.m. So let's see what I said in the article. We just saw that the core retail sales numbers came in well below expectations. So what should we expect from the retail sales report, which measures changes in the total value of sales at the retail level, including automobiles? So the core retail sales excludes automobiles, and the retail sales includes automobiles. So that's the difference between the two sales, retail sales, all right? We should expect to come in below expectations also, although automobile sales and online sales have improved. But by how much? Not that much, because the actual number, 0.4%, came in well below the previous reading of 0.8% in July, while beating out a low confidence induced forecast of 0.2%. Why would expert economists develop a lowball forecast of 0.2%, well below the previous reading of 0.8%, if they didn't think that the economy was growing slowly or slowing down? You tell me. Okay? There we have it. The U.S. economy is currently experiencing slow growth or possibly slowing down. Can't disagree with me. I have data to back it up. What are we going to do about it? Well, we should hope that things pick up soon, because if such economic slowdown continues, we could end up sliding headfirst into the teeth of a recession, which wouldn't be a good thing for any economy. Recessions aren't good. Things that happen in recessions are stock market crashes, depressions. Stock market crashes and economic depressions are usually the outcomes of recessions that get out of control. That's what I wrote in the article. Check it out. So, we definitely wouldn't want that to happen, would we? During the stock market crash of 2008, portfolio values in the equities market dropped more than 50%. And during the Great Depression of 1929, that's October 1929, 2008 stock market crashes happened in September. So between September and October, crazy things that usually happens. So you want to hear what happened? In the Great Depression of 1929, portfolios lost 90% of their values. Wow. So, how can we, as citizens of this great nation, prevent a recession? Please post your responses in the comment area below this video, because I know many people have many opinions, and I like to hear opinions. But how am I gonna hear your opinions if you don't post your opinions in the comment area below the video? Thank you for watching my video. Please like, subscribe, and hit the bell as hard as you can so you can see when I upload new videos to my channel. If your comment is helpful to society, I will shout you out in my next video. Thank you. Have a great day.